I'm Jean Carter, an ACTEC Fellow from Raleigh, North Carolina, and with me is Michael Barker, an ACTEC Fellow from Richmond, Virginia. Our topic today is paying for college for grandchildren or nieces and nephews. And Michael, before we start, perhaps we should define the topic a little better. What exactly are we talking about on paying for college? Do I have to worry about taxes on paying for college for my child?
Gene, that's a great question, a good place to start, because paying for your own child to go to college is a fairly easy experience from a tax perspective, because parents are deemed to have an obligation of support for their children. So most payments for college expenses would not constitute gifts for gift tax purposes. So really, this topic is focused on making payments to support others to go to college, such as grandchildren, as you said, nieces and nephews, friends, whomever it might be, who's not your child, and doing so in a tax efficient way. And I should also say, Gene, that we're not talking about charitable planning. We're not talking about making gifts to the institution for charitable purposes, really just focused on the gift tax aspects of planning for college.
So specifically, we're talking about a gift tax efficient way for me to pay for college for my grandchild or niece and nephew or someone else, correct?
That's right, Gene. And we can sort of walk through a menu of options of ways to consider doing that. And maybe the right place to start is the easiest thing to do, which is to make a gift. If you have an adult grandchild, for instance, who's 18 or older, who's starting college, and you want to pay some of those expenses, that's easy. You can transfer assets to that adult. And from a gift tax perspective, each individual has what's referred to as an annual exclusion amount. The annual exclusion under current law in 2022 is $16,000 per year, per donor, per recipient. So in other words, a married couple can give a beneficiary $32,000 in any given year without having any gift tax consequences. And you can make those types of gifts year after year after year. And that covers a lot of what most people are trying to do.
Definitely that would. Well, what if my grandchild is still, 4 years old and I want to start building up for college? Well, what do I do?
If your beneficiary is a minor and a minor cannot own assets, then you've got to find a different type of account for the recipient money to go. A couple of options. One, maybe not the most efficient, but a simple one, make a gift to the child's parent and say, hey, set this aside for little Susie. And, in 15 years when she goes to college, I want you to use it for that. That'd be easy. But if you want something that's a little more direct and a little more controlled, you might consider a custodian account. Sometimes these are referred to as UTMA accounts, so you might see that referenced. A custodian account is very simply an account for a minor that's managed by an adult. So you can transfer assets from your account to a custodian account. You can appoint yourself, your spouse, or anyone else, the child's parent, if you think that's appropriate, as custodian to manage the money, to invest it on behalf of the minor. It can be used to pay tuition or other things for the benefit of the minor. And then anything left over when the child reaches adulthood, either age 18 or 21, depending on the jurisdiction, those assets go outright to the beneficiary.
Well, that's a great way to get ahead on it. Are there others?
Yeah, I think, that's a really simple approach. Another option that's more complex might be involving using an annual exclusion trust. And these types of trusts have some more complexity. They're better for bigger, more sustained gifts over time. And there's a lot of complexities that go along. They're sort of outside the scope of what we'll talk about today. But just know that if long-term trusts might be a good planning opportunity for larger gifts. But if you're focused more on directly educational expenses, one thing that a lot of people use is what's called the 529 plan. Sometimes it's referred to as a qualified tuition program. These are state-run programs. Many states, but not all states, have 529 plans. And essentially, these are accounts for the benefit of a student, a minor, that you can transfer assets to. And the big benefit of these 529 accounts is that the assets will grow when they appreciate and when the investments appreciate over time. All that growth happens tax-free, and there's no tax on distributions out of the 529 plan for the benefit of the beneficiary when he or she eventually goes to school and those monies are used for college costs. The other benefit of 529 plans is that many states have a state income tax deduction or credit to encourage savings. So you can, when you make a donation to a 529 plan to benefit your niece or nephew, for instance, you personally can take an income tax credit in many states. There's usually some limits on those, but worth considering. The other benefit of 529 plans is that you can front load 5 years worth of annual exclusions. So I mentioned earlier that the annual exclusion amount is $16,000 a year. When you're contributing to a 529 plan, that amount is $80,000 a year, or $160,000 for a married couple, which could go a long way towards solving college expenses.
That's great. I've also heard a mention of an education, a Coverdell account.
Yeah, Jean, Coverdell accounts are very similar to 529s. They're not state-run programs, but they are found at any bank or financial institution. And it's the similar idea insofar as appreciation can grow free of tax. There's some limitations on who can contribute to a Coverdell account and what types of contributions can be made in terms of the size. The Coverdell accounts generally are designed for middle class and upper middle class individuals. And so if a person's adjusted gross income for any given year is above $110,000 or $220,000 for a married couple, if it's above that, then you can't contribute to a Coverdell account. If it's below that amount, you can contribute, but only up to $2,000 per year. There are some other rules and limitations if a beneficiary also has a 529 plan, so you've got to be really careful when you're making contributions to a Coverdell account.
This is great information if I had time to do it, but what if the child is already 18 and he wants to go to a private university with $70,000 a year tuition? What do I do now?
A direct payment to the college. Okay. The payments made directly from a person to an educational institution that are used for tuition, not room and board, but just for tuition, those payments are not deemed a taxable gift. Sometimes these are called 2503E gifts. I reference that only because you might see it as you look around on the internet. That's the Internal Revenue Code section that authorizes those gifts. But a lot of folks use those direct transfers to the institution to pay tuition because those are not deemed a gift.
Michael, this has been some very useful information. If I had grandchildren, I'd use it. Thank you very much for telling us about this.
Absolutely. I'll maybe make 2 closing comments just to wrap things up. One is a caution and one is a resource. As a caution, I always remind folks to be careful with gifts when a beneficiary might be seeking need-based financial aid, because many gifts can impact a student's eligibility for need-based financial aid. And so you wouldn't want to mess up what they were doing. And then secondly, a resource. The IRS has a publication called Publication 970, and that is a publication that's readily available online and has lots of detailed information about options for planning from a tax perspective for college expenses, and can be a useful tool for folks. And so I would commend that to your reading.
This is great. Thank you.
Thanks, Jean.